Good afternoon, everybody, and thanks very much. Just going to give you an update on Orezone, our Bombore project, and sort of where we are going in the next couple of years. Forward statements, just take your time to read them when you get a chance. So we're in Burkina Faso. It is a great mining jurisdiction. I know it's got a lot of, sort of interesting press over the past number of years, but I can tell you I've been there many, many times. It's a very good place to do business. There's 16 mines into production. The majority of them being built on time, on budget. Very strong support from communities, a great worker base in terms of technical skill sets at our Burkinabe. We're running a 6 million ton per annum mine, open pit, with 3 expats. That gives you a level of the type of skill sets there are in the country. It is ideally located. We're on a paved highway. It's about an hour and 15 minutes from the capital by paved highway. We carry about $4 million of working capital, so about 3 to 4 weeks. That's all we have on site. So regular deliveries, great place to do business, and excellent infrastructure. So we built phase 1 in 2021, 22, just after COVID. We built it on time, under budget. Excellent achievement. We within 30 days we were at commercial production. Since then we've been over nameplate consistently. We've issued a study on phase 2, which will bring us to around 200,000 ounces plus, and we'll grow beyond that. There's more drilling, more resources to come. Phase 3 will bring us to over 250,000 ounces. It is tier 1 potential, and I'll show you that as we go through it. It's got excellent upside, still wide open. Average depth of drilling is around about 160 meters. And of the 2 million ounces that we've got in reserve now, the average pit depth is under 40 meters. So that goes to show you the potential that we've got as we continue to develop this project. It's wide open. So phase 1. First year of commercial production, which just ended, we did 141,000 ounces of production, which was just at the bottom end of guidance. No lost time injuries, which again shows you the type of operation that we are running. We've just connected to grid power. During 2023, we were running on diesel gensets. Power generation was costing us about 60 cents a kilowatt hour. We'll now go down to 21 cents a kilowatt hour, which will bring around about $140 an ounce from our all-in sustaining costs. So that was achieved again on time and on budget, and we're now connected to that grid. And our debt reduction, we carried about $90 million of debt to build this project. And in year 1, we paid over a third of that debt down. So for a junior company to run the mine, build a brand new power line, build new houses for the local communities, and we've also paid down $33 million of debt in that same year. It gives you an idea of the robustness of the project. So phase 2 is a hard rock. The current phase 1 is oxide, which the oxide will run for about 14 or 15 years, but we're building a hard rock expansion to go along with that. That'll bring us up to around about 200,000 ounces a year. Still very shallow in the hard rock. We expect to go to 250, as I said. First 3 years is 231,000 ounces. Life of mine production of 2.1 million ounces over approximately 11 years. And as I said, that comes from an average pit depth of around about 30 to 40 meters. The deepest pits are around 160 meters into the reserve, so still wide open. Average strip ratio is under 2 to 1. So you can see that we've got lots of flexibility. A lot of West African producers round about 6 to 1 strip ratio. So again, still wide open. Very robust economics, about $640 million at $1,750 gold. We did the reserves at $1,500. If we do the reserves at $1,700, we add about 1 million ounces to the reserve base alone. Low strip ratio, as I said, and capital intensity, which I look at all the time. It's 167 million. If you were building a 6 million ton per annum hard rock greenfields, it would cost you around $200 dollars. Sorry, about $120 per ton per annum. We're building this for about $40 per ton per annum. That's a very important number. It's how I benchmark projects, how I see if they're within a capital intensity that I believe is realistic. Great infrastructure. Why are we able to build it for that capital intensity? Because the camp's in place, the water systems are in place, the power line's in, there's the substation. We've built all of these villages to rehouse people. We've already rehoused 3,300. We'll be moving another 3,000 in March of this year. Tailings dams in place. It's all just sustaining CapEx from here on in. So that's what keeps the project at a very low CapEx per ounce produced. Communities, I don't care where you are. I've built mines all over the world. And community relations and community support is critical. This started right at the exploration stage for us. We've been training people to be operators on the mines. In fact, some of the ladies are geologists, they're mill superintendents, etc. So the local community support is phenomenal. You know, a lot of restaurants have opened up in the areas because the mining contractors eat in the area. So lots of new businesses that we have created. That wealth is now going back into the communities. We're setting up with our local, there's another mining company right beside us called West African Resources. They produce about 200,000 ounces a year. And we're in the process of planning a technical school where we can train welders, heavy duty mechanics, etc., all from the local communities. So those jobs all stay local. So lots of opportunities for future growth. As I said, we can expand this where it goes beyond the 200,000 ounces a year, and I'll show you why. We're also producing a lot of low-grade stockpile right now. It's all soft rock. It's not hard rock. So we've just had a study in to look at reclaiming that using hydraulic mining, similar as they do in South Africa with tailings. They mine tailings in South Africa at 0.2 of a gram, get 50% recovery and do it for less than $1,000 an ounce. We're looking at about 0.3 to 0.5 of a gram, and we'd be doing it for about 30 cents a ton. So our margin is huge on that going forward as well. So we did the reserves at 1,500. You can see just by going to 1,700 what additional we add to that. It's all good grade material. So we're working on that right now. So again, we expect to show that this will be a constant, consistent 250,000 ounce a year producer at very reasonable gold prices. And tier one potential. Why do we say that? Right now, it's a large shear zone, about 13 kilometers in length. And you can see a cross-section of that. The pits are literally just right at surface. So there's huge potential to go at depth. We've drilled some deep holes. We're heading in the region of 12 meters at 10 grams, 30 meters at 5.5 grams that we're now seeing in folded structures. We expect to get back in drilling this year to test those again. So we see real opportunity here. For the first time ever, we've had a structural geologist on this project, mainly because the previous guys were looking at the oxide, not at the hard rock. So this is the first real look at the hard rock potential here. Just to give you a context, there's a number of, in the Birimian, where we are in West Africa, world-class deposits that have a footprint of about 3 to 5 kilometers. Lulu, Marilla, those type of projects. And once you get into depth and you find the roots of the systems, you hit real potential here. And we're hoping to see something like that as we continue to drill at depth. A couple of large shareholders being big supporters, RCF out of Denver, Equinox out of the US, FANEC. We've got a very, very solid shareholder base. We were hit by the Niger coup, which had really nothing to do with us, went to 80 cent stock, but really everything that we've done has been exactly as we said we would do it. Large following in the research community for a junior single asset company. Again, I hope to be a multi-asset company here in the coming years as we continue to look at opportunities in the West African region. So in conclusion, Robust study. We've been hitting all our metrics in terms of our costs, our production, etc. We've now connected to the grid. We've got a study showing that we're going to expand beyond where we are today. We're in a great location for looking at expansion and acquisitions. And we also have a strong local bank supporting us who are, again, actively involved in the region. So we expect to continue to leverage off that as we grow. And I will be doing a talk on, hopefully, how to win in the mining business. I have been involved with a lot of successes, and I can give you some of my insights as to why I think that what to look for to make that a success. Thank you.